In the world of finance, opportunity and risk go hand in hand. This adage has been proven time and again as individuals and entities, blinded by the allure of quick and immense profits, have orchestrated some of the most audacious financial frauds in history. Today, we delve into the dark underbelly of the financial world, where greed, manipulation, and deceit have led to some of the most notorious stock market scams. These scams have not only defrauded unsuspecting investors of their hard-earned money, but have also shaken the very foundations of our financial systems. From exploiting loopholes to creating elaborate webs of lies, the masterminds behind these scams have left an indelible mark on the history of finance. Let's take a journey back in time to a period marked by economic growth and optimism, the 1920s. This was when Charles Ponzi promised high returns through arbitrage in international reply coupons, setting in motion a scheme that would bear his name for all of eternity. The Ponzi scheme, as we now know it, became a blueprint for future frauds. Fast forward to the 1990s, where a man named Harshad Mehta manipulated the Indian stock market, causing a market crash and massive losses for investors. This was followed by a series of corporate scandals in the early 2000s, with names like Enron, WorldCom, and Tyco International becoming synonymous with fraudulent accounting practices and corporate misgovernance. And who can forget the Bernie Madoff Ponzi scheme of 2008? In the midst of a global financial crisis, this scheme was unraveled, revealing one of the largest investment frauds in history. The consequences of these scams have been far-reaching, leading to bankruptcies, regulatory reforms, and a loss of faith in the financial system. Each of these scams has a story to tell, a lesson to impart. They serve as stark reminders of the devastating impact of financial fraud on investors and the system at large. They underscore the need for vigilance, due diligence, and robust regulation in the world of finance. Join us as we journey through time, unraveling the cunning plots and disastrous consequences of some of the most notorious stock market scams. The year was 1992. The Indian stock market was about to face one of its biggest scams. Enter Harshad Mehta, a stockbroker with a knack for exploiting the system. Harshad was not just a stockbroker, he was a master manipulator, a puppeteer who knew how to pull the strings of the stock market. He had an ingenious method: circular trading. It's a practice where a group of market players creates artificial activity in the market by buying and selling shares among themselves, raising their prices in the process. The inflated prices would lure in unsuspecting investors who would then buy the overpriced stocks. But how did Harshad fund this operation? This is where the loopholes in the banking system come into play. Harshad discovered a chink in the armor of the banking sector: the Ready Forward deal. This was a short-term loan facility provided by banks to each other, facilitated by brokers. Harshad found a way to forge bank receipts, which he used as collateral to secure loans from other banks. This money was then used to inflate the stock prices. It was a house of cards, a ticking time bomb waiting to explode. And explode it did. When the scam was exposed, the market crashed, wiping out billions of rupees in investor wealth overnight. The bubble Harshad had created burst, leaving a trail of financial destruction in its wake. Investors, many of whom had put their life savings into the market, were left high and dry. The dream of quick riches turned into a nightmare of losses. The shockwaves of the scam were felt far and wide, leading to a crisis of confidence in the Indian stock market. The aftermath of the Harshad Mehta scam was a wake-up call for the Indian financial system. It led to a complete overhaul of the banking system's regulations and the establishment of new regulatory bodies to oversee market operations. The Harshad Mehta scam triggered a seismic shift in India's financial regulations. Scene script: rewind to 1920. Charles Ponzi promised investors hefty profits through an unusual arbitrage opportunity. Let's take a step back into the roaring 20s, when a man named Charles Ponzi hatched a plan that would forever bear his name. Ponzi, an Italian immigrant in the United States, had an alluring proposition. He promised a 50% return on investment in just 45 days or 100% in 90 days. The secret, he claimed, was a clever arbitrage scheme involving international reply coupons used for overseas postage. Now, let's unravel the workings of this infamous plan. Ponzi's scheme didn't involve any genuine investment. Instead, he used the funds from new investors to pay the promised returns to the earlier ones. This created an illusion of a highly lucrative business, attracting more and more investors. As long as new investors kept coming in, Ponzi could keep the operation running. But as we now know, this was a house of cards waiting to fall, and fall it did. The scheme began to unravel when the Boston Post started to investigate Ponzi's returns. They found that the profits from the international reply coupons would have been minuscule and nowhere near enough to cover the promised returns. The revelation triggered a panic. Investors rushed to withdraw their money and the scheme collapsed under its weight. The fallout was catastrophic. Thousands of investors were left in financial ruin, having lost millions of dollars. Ponzi himself was convicted of mail fraud and spent years in prison. His name now, however, lives on as a term for any scam that uses funds from new investors to pay returns to earlier ones. Ponzi's name is now infamously synonymous with financial fraud. This tale serves as a stark reminder of the dangers of too good to be true investment opportunities. It's a cautionary tale that continues to echo in the financial world, even a century later. Fast forward to 2001. A corporate giant named Enron was about to fall. Enron, once a darling of Wall Street, was a Houston-based energy company that had seemingly achieved astonishing success in the late 1990s and early 2000s. But behind the scenes, a different story was unfolding. Enron was using complex and, in some cases, downright deceptive accounting practices to hide its debt and inflate its profits. Perhaps the most notorious of these practices were off-balance sheet transactions. These are financial dealings that, while technically legal, do not appear on a company's official balance sheet. Enron used these transactions to hide its mounting debt and to give the illusion of robust financial health. It was a house of cards built on financial trickery. But as with all unsustainable practices, the truth eventually came to light. In October 2001, Enron disclosed a quarterly loss of $618 million and a reduction in shareholder equity of $1.2 billion. These revelations shocked the financial world and triggered a rapid decline in Enron's stock price. By December 2001, Enron had filed for bankruptcy, wiping out billions in shareholder value and leaving thousands of employees with worthless retirement accounts. The fallout from Enron's collapse extended far beyond the company itself. It led to the dissolution of Arthur Andersen, one of the world's largest accounting firms at the time, which had been complicit in Enron's deceptive practices. The Enron scandal had a profound impact on corporate governance. It led to a renewed focus on financial transparency and accountability, and it was a driving force behind the Sarbanes-Oxley Act of 2002. A landmark piece of legislation designed to protect investors from fraudulent accounting activities by corporations. In the end, the Enron scandal served as a stark reminder of the dangers of unchecked corporate greed and the importance of rigorous financial oversight. It was a painful lesson learned at great cost by investors, employees, and the broader financial community. The Enron scandal marked a dark chapter in corporate governance. Barely a year later, in 2002, WorldCom, a telecom titan, was caught in a web of deceit. This was a company that was once held in high regard, but it had been quietly spiraling out of control due to fraudulent accounting practices that would eventually lead to its downfall. At the heart of this scandal was a tactic known as the improper capitalization of costs. Essentially, WorldCom manipulated its financial statements by incorrectly categorizing billions of dollars in operating expenses as capital expenditures. This allowed WorldCom to spread the costs over several years, artificially inflating its profits and deceiving investors about the company's true financial health. But the deceit didn't stop there. WorldCom also created fictitious accounting entries to further enhance its financial standing. These entries were designed to offset the company's actual costs, creating a mirage of profitability. This manipulation was so extensive that it led to an overstatement of WorldCom's income by a staggering $11 billion. This house of cards, however, couldn't stand forever. The truth eventually surfaced, and what followed was a catastrophic collapse. WorldCom filed for bankruptcy in July 2002, marking the largest bankruptcy in US history at that time. Investors were left in shock as their investments evaporated and thousands of employees were left jobless. But every cloud has a silver lining. In the aftermath of the WorldCom scandal, regulatory reforms were implemented to prevent such fraudulent activities in the future. The US Congress passed the Sarbanes-Oxley Act, aimed at enhancing corporate accountability and financial transparency. This act was a significant step towards restoring trust in the financial markets. The WorldCom scandal serves as a stark reminder of the devastating consequences of corporate greed and unethical practices. It underscores the importance of due diligence and the need for stringent financial oversight in the corporate world. But most importantly, it teaches us that even the mightiest can fall, and that integrity and transparency are the cornerstones of a sustainable business. WorldCom's fall from grace was a wake-up call for tighter financial controls. Also in 2002, Tyco International was embroiled in a scandal that shocked the corporate world. Tyco International, a diversified manufacturing conglomerate, was at the eye of a storm that unveiled a tale of corporate greed and deception. The main actors in this scandal were none other than Tyco's CEO, Dennis Kozlowski, and CFO, Mark Swartz. Kozlowski and Swartz were the masterminds behind a grand scheme of unauthorized compensation and fraudulent practices that led to the looting of the company. They were found guilty of awarding themselves interest-free or low-interest loans without the approval of Tyco's compensation committee. These loans, which were disguised as bonuses, were never returned to the company. Not stopping at that, they sold their company stock without informing shareholders while artificially inflating the value of Tyco's stock by lying about the company's financial health. Over time, these actions resulted in an estimated loss of over $600 million to the company. But every action has a reaction, and in the corporate world, misdeeds often come with heavy repercussions. The fallout from the Tyco scandal was significant. Tyco's stock price plummeted, erasing billions in market value. The scandal also led to a loss of trust in corporate leadership, causing investors to view with skepticism the actions of top executives in other corporations. The legal consequences were equally severe. In 2005, Kozlowski and Swartz were convicted on multiple counts of grand larceny, conspiracy, falsifying business records, and securities fraud. They were each sentenced to a minimum of 8 years and 4 months and a maximum of 25 years in prison. The Tyco scandal is a stark reminder of how unchecked corporate greed can lead to devastating consequences. It highlights the importance of corporate governance, transparency, and the need for checks and balances to prevent the misuse of power by those at the helm. The Tyco scandal underscored the high cost of corporate greed. In 2008, Wall Street was rocked by a scandal of epic proportions. Bernie Madoff, a former chairman of NASDAQ and a respected figure in the finance world, was arrested for running the largest Ponzi scheme in history. The scale of the fraud was staggering, with an estimated $50 billion lost by investors. Madoff's operation was a classic Ponzi scheme, albeit on an unprecedented scale. His firm promised unusually high and consistent returns, attracting a wide array of investors from individuals to large institutions. But behind the scenes, there were no real investments. New investors' money was used to pay off older investors, creating the illusion of genuine profits. The scheme was shrouded in secrecy, with Madoff insisting on handling all investments personally. However, like all Ponzi schemes, Madoff's operation was doomed to fail. The entire system hinged on a constant influx of new investors, but when the financial crisis of 2008 hit, new investments slowed and older investors began demanding their returns. The house of cards came tumbling down. In December 2008, Madoff confessed to his sons, who then reported him to federal authorities. The aftermath was devastating. Aside from the massive financial losses, the scandal shook investors' confidence in the financial system. Madoff was sentenced to 150 years in prison, the maximum allowed under federal law. But the impact of Madoff's scheme didn't end with his sentencing. The scandal led to a renewed emphasis on regulatory oversight and investor due diligence. It highlighted the dangers of not questioning where and how high returns are generated. Madoff's fall served as a stark reminder of the perils of blind trust in the financial world. From Ponzi to Madoff, these scandals have left indelible marks on the financial landscape, each one a chilling reminder of how unchecked ambition and unscrupulous practices can undermine the very pillars of the financial ecosystem. Revisiting the Harshad Mehta saga, we saw how one man's manipulation of the banking system led to a catastrophic market crash. This scam underlined the need for robust checks and balances within the banking system to prevent such manipulation. Then we delved into the infamous Ponzi scheme by Charles Ponzi. His story is a stark reminder of the dangers of promises that seem too good to be true. It teaches us the importance of due diligence and skepticism, especially when high returns are promised with little to no risk. The Enron scandal, one of the most notorious corporate frauds, highlighted the perils of accounting manipulation and off-balance sheet transactions. It served as a wake-up call for stricter corporate governance and transparency in financial reporting. The WorldCom accounting fraud showed us how deceptive accounting practices can lead to the downfall of even the largest corporations. It emphasized the need for stringent auditing and regulatory oversight to deter such fraudulent activities. The Tyco International scandal, involving its top executives, demonstrated how unchecked power can lead to the looting of a company. It underscored the importance of internal controls and ethical leadership in corporate governance. And lastly, the Bernie Madoff Ponzi scheme, one of the largest investment frauds, reiterated the dangers of blind faith in investment advisors and the significance of independent verification. Each of these scandals teaches us invaluable lessons. They stress the need for better regulation, due diligence, and vigilance in the financial markets. They remind us that while the pursuit of wealth is universal, it must be tempered with ethical considerations and sound judgment. But remember, the onus is also on us, the individual investors, to stay informed and vigilant. Because in the world of finance, it's often the unseen risks that pack the hardest punch.